Hey everyone, welcome back to Corporate Decoder. Today, BNAI just filed their quarterly report, and I am seeing some serious moves in their cash and debt situation that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing a big jump in cash, but also has some significant liabilities to manage. Let's dive into their financial snapshot from the 31st of March 2026. First off, the company has about $1.8 million in cash and equivalents. That is a big jump from just $172,000 at the end of 2025. This shows they've managed to bring in more money, which is generally a good sign. Overall, their total assets are around $16.3 million, up from about $15.3 million at the end of the previous year. This growth in assets is largely driven by that cash increase. Now let's look at the other side of the coin, the liabilities and equity. Total liabilities stand at about $9 million, which is down from over $11.8 million at the end of 2025. That is a good reduction in what they owe. A big part of that decrease comes from accounts payable, which dropped from over $5 million down to about $3.3 million. This means they paid off a good chunk of their bills to suppliers. They also managed to lower their short-term debt significantly from $1.3 million down to just over $300,000. However, they still have $760,000 in convertible debt. This is debt that can be turned into stock, which can be a tricky situation. Their total liabilities are still substantial, at over $8.3 million for current liabilities, meaning what is due within a year. When we look at stockholders' equity, which is what is left after you subtract liabilities from assets, it is about $7.2 million. This is a pretty big increase from just $3.4 million at the end of 2025. This jump is mainly because of additional paid-in capital, which went up from $59 million to almost $66 million. This suggests they sold more stock or received more money related to their stock. But here is a key point, they still have a huge accumulated deficit of almost $59 million. That is a running total of all their past losses. So, while they have more cash now, they have a long way to go to become profitable overall. Let's look at how they made out in the first quarter of 2026. Their revenue was about $104,000. That is a big jump from just $10,000 in the same period in 2025, which is positive but still very small. The company reported a loss from operations of about $3.3 million. This is better than the loss of $4.1 million in the first quarter of 2025. So they are losing less money, which is good progress. There was a gain of about $294,000 from the change in fair value of warrant liabilities. This can happen with financial instruments and is often a non-cash item. Overall, the net loss for the quarter was about $3 million. This is an improvement from a net loss of $3.6 million in the same period last year. Interestingly, the number of weighted average common shares outstanding more than doubled, from about 4 million to over 5.9 million shares. This indicates a lot more stock is out there, likely due to the stock sales and warrant exercises we saw in the balance sheet. This means that even though the net loss is smaller, the loss per S-share is about 51 cents, which is better than 90 cents per share in the prior year, but still a significant loss for each share of stock. In the cash flow statement, we see that ending cash balance of $1.8 million. That is a huge increase from the $236,000 at the start of 2025. However, their operating activities used up about $3.7 million, so their day-to-day business still burns through a lot of cash. The good news is that financing activities brought in about $5.5 million. This came from things like warrant exercises and selling more stock, which helped them end up with more cash overall. Under the going concern section, the company admits that its current financial situation raises substantial doubt about its ability to continue as a going concern. This is a serious warning. Management believes they will need more money from equity financings or other means to keep operating for the next 12 months. This is a classic situation for smaller companies that are still trying to get their business off the ground. Looking at their property and equipment, it is relatively small at about $278,000. This suggests they are not a company with a lot of heavy manufacturing or large physical infrastructure being used. Their value here is likely in their technology and intellectual property. And that brings us to intangible assets, which total over $12.1 million. This is a huge part of their reported assets. A large chunk of this is in process research and development valued at over $11.5 million. This shows the company is heavily invested in developing new technology, which is expected for an AI company. The debt section is a bit concerning. They have about $760,000 in convertible debt, and they were actually in default on one of their convertible notes as of the 31st of March, 2026. While they are in negotiations, a default is a serious issue. They also have short-term loans with over $318,000 still outstanding. This section details their stock and warrant activity. It shows they've been issuing a lot of shares and warrants, especially through various purchase agreements like the May SPA and August SPA. These agreements have seen them issue stock and warrants in exchange for cash. For example, they closed a $1.5 million private placement in March 2026. They also received about $4.5 million from warrant exercises. This is how they are raising a lot of cash. But it also means a lot more shares are outstanding, which can dilute existing shareholders. Here we see some legal battles. The company is suing AFG and its CEO for fraud and breach of contract. They also have a lawsuit against AFG for failing to make a large payment related to a subscription agreement. AFG has counterclaimed. These are significant legal issues that could have a financial impact if they go poorly for Brand Engagement Network, Inc. The company describes itself as an emerging provider of conversational artificial intelligence assistance. They aim to transform engagement and analytics for businesses. They believe their AI assistants will help companies improve customer experiences and efficiency. They also highlight their patent portfolio as a cornerstone of their AI solutions. As mentioned, their revenue is still very small. They are a development stage company and have not generated any significant revenue yet. This is a critical point to understand. They are still in the very early stages of commercializing their technology. This section echoes the going concern warning from Note A, stating that their current cash and expected proceeds might not be enough for the next 12 months. They explicitly state they need to raise more capital. This reinforces the risk that they might struggle to continue operating without further funding. They are trying to secure this through equity and debt, but there is no guarantee of success. Looking at the cash flow summary again, the story is clear. They are burning cash from operations, but they are bringing in money from financing activities, mainly selling more stock and warrants. This is a common strategy for early stage tech companies, but it relies heavily on their ability to keep attracting investors. Here is a critical disclosure. The company states that their disclosure controls were not effective as of the 31st of March 2026. They identified a material weakness in their internal controls over financial reporting. This means they have issues with how they account for things and prepare their financial statements. And there is a risk that mistakes might not be caught. They are working on fixing this by hiring a CFO and improving their accounting processes, but it is an ongoing effort. This again details the ongoing lawsuits with AFG. The company claims AFG committed fraud and breached contracts, and AFG is fighting back. The financial impact here is uncertain, but legal battles are costly and can distract management. The risk factors haven't changed much since their last report. They list things like their ability to get more funding, competition in the AI space, and the volatility of their stock. A big one is their ability to meet the conditions to close their pending acquisition of Cataneo GmbH. This acquisition is a major strategic move, and any failure to complete it would be a significant setback. This is where all the important documents are listed. It includes various agreements related to their business combinations, stock purchases, and other corporate actions. Overall, Brand Engagement Network Inc. is in a classic startup phase. They have exciting technology in AI and have secured patents for it. They are successfully raising cash through multiple equity and warrant deals, which is keeping them afloat and growing their asset base. They are also improving their operational losses. However, the significant accumulated deficit, the material weakness in financial controls, and the ongoing legal disputes with AFG are major red flags. Their reliance on continued financing and the possibility of not being able to close the Cataneo acquisition are substantial risks. The company is essentially betting on its technology and future growth to overcome these challenges. My biggest concern is their ability to navigate the ongoing financial and legal headwinds while scaling their AI solutions to generate meaningful revenue. What I'm actually looking for is a clear path to profitability and a strengthening of their internal financial controls. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord for more.